Warren Buffett, the Oracle of Omaha, is a legend. He's a master investor who built a fortune through his company, Berkshire Hathaway. But here's a twist. Buffett has often said most investors would be better off skipping Berkshire Hathaway's stock. Instead, he recommends a simpler approach. Invest in the S&P 500 index fund. This advice might seem strange coming from a Wall Street titan. Why would anyone choose a simple index fund over a chance to invest with Buffett himself? The answer lies in the power of steady long-term growth. Buffett understands that trying to beat the market is risky and often futile. He believes in the potential of American businesses. He sees the S&P 500 as a reflection of that potential. Investing in the S&P 500 is like buying a tiny slice of the entire U.S. economy. You're betting on the collective strength and innovation of America's 500 largest companies. And history has shown that over the long run, the American economy tends to grow. This isn't about getting rich quick. It's about slow, steady growth. It's about letting your money work for you, year after year, decade after decade. It's about harnessing the power of compound returns, which is like earning interest on your interest. Buffett's advice is simple but profound. Slow and steady wins the race. The S&P 500 Index Fund is like a diversified basket of stocks. It includes companies from all sectors of the economy, technology, healthcare, finance, and more. This diversification is key. It spreads your risk, making your investment more resilient to market swings. Think of it this way. If one company in the index stumbles, it's unlikely to drag down your entire investment. The other 499 companies can cushion the blow. This built-in safety net makes index funds a less volatile option compared to individual stocks. The S&P 500 has a long track record of delivering solid returns. Over the past 30 years, the average annual return has been around 10%. This means that if you had invested $10,000 in an S&P 500 index fund 3 decades ago, your investment would be worth well over $170,000 today. Of course, past performance is not a guarantee of future results. But the historical performance of the S&P 500 provides a glimpse into the potential of this investment strategy. It shows that over the long term, investing in a diversified basket of American companies can be a powerful way to build wealth. Now let's talk about the future. The investment landscape is constantly evolving. Today, one of the most significant forces shaping the future of business and finance is artificial intelligence, AI. AI is no longer science fiction. It's here, it's real, and it's changing the world as we know it. From self-driving cars to personalized medicine, AI is poised to revolutionize countless industries. And guess what? The S&P 500 is perfectly positioned to capitalize on this AI revolution. Many companies within the index are at the forefront of AI development and implementation. These companies are integrating AI into their operations, using it to boost efficiency, enhance productivity, and create innovative new products and services. As AI continues to advance, these companies are likely to reap the rewards. And as an investor in the S&P 500, you get to share in their success. Let's look at 2 specific examples: NVIDIA and Microsoft. NVIDIA is a leading manufacturer of graphics processing units, GPUs, which are essential for AI applications. Microsoft, a tech giant, is heavily investing in AI across its product line, from cloud computing to gaming. These companies are just 2 examples of how AI is transforming the business world. As AI becomes increasingly sophisticated, NVIDIA and Microsoft are well-positioned to benefit from its growth. And because both companies are part of the S&P 500, investing in this index fund gives you indirect exposure to their AI-driven growth. It's like hitching your wagon to a rising star, or in this case, 2 rising stars. This is the beauty of index fund investing. You don't need to pick and choose individual stocks or try to time the market. By investing in the S&P 500, you're automatically invested in the companies that are shaping the future, including those at the forefront of the AI revolution. Now, let's talk about compound returns. This is where the magic really happens. Compound returns are essentially interest on interest. Imagine you invest $100 and it earns a 10% return in the first year. You now have $110. But in the second year, you earn 10%, not just on the original $100, but on the $110. This means your money grows faster and faster over time. The longer you stay invested, the more powerful the compounding effect becomes. Albert Einstein is said to have called compound interest the eighth wonder of the world. He understood that time is the investor's greatest ally. The earlier you start investing, the more time your money has to grow exponentially. Let's look at a hypothetical example. Imagine you start investing $350 per month in an S&P 500 index fund at age 25. Assuming an average annual return of 8%, you would have over $1 million by age 65. Now, imagine you wait until age 35 to start investing the same amount. By age 65, you would have significantly less, around $550,000. That's a difference of almost $500,000 simply because you gave your money more time to grow in the first scenario. This highlights the importance of starting early and staying invested for the long haul. The earlier you start, the more you benefit from the power of compound returns. Of course, not everyone has the luxury of investing $350 per month starting at age 25, but the principle remains the same. The earlier you start, even with smaller amounts, the better off you'll be in the long run. So, how do you get started? It's easier than you might think. First, you need to choose a brokerage account. There are many reputable online brokers that offer low-cost index funds, including Vanguard, Fidelity, and Schwab. Once you've opened an account, you can set up automatic investments. This means that a fixed amount of money will be automatically deducted from your bank account and invested in your chosen index fund each month. This set-it-and-forget-it approach is a powerful way to stay disciplined with your investing. It takes the emotion out of the equation and ensures that you're consistently investing, regardless of market fluctuations. Remember, investing is a marathon, not a sprint. It's about making consistent contributions over time and letting the power of compound returns work its magic. Investing in index funds, particularly those tracking the S&P 500, is a strategy endorsed by Warren Buffett and countless other financial experts. It's a simple, effective way for regular people to build wealth over the long term. And with the rise of AI, the future of the S&P 500 looks brighter than ever. As AI continues to transform industries and drive economic growth, the companies within the S&P 500 are well positioned to benefit. Investing in this index fund is a bet on the future of American innovation and the continued growth of the U.S. economy. Remember, slow and steady wins the race. Start investing today and let the power of compound returns help you achieve your financial goals.